Welcome, everyone, and thank you for joining us today. This is the Capital Rules and the Impact on the Mortgage Ecosystem webinar. All participants will be placed on mute during the presentation, but during the Q&A session, feel free to unmute yourself to ask questions. You can also submit them to us through the question function in your webinar app. This webinar will also be recorded. The recording and slide deck will be sent out within a few days. CPE credit is available to attendees who answer all 4 poll questions scattered throughout the presentation. If you are looking to get CPE, you must answer all 4 polls to be eligible. If you qualify, the CPE certificates will be sent to you via email within the next few weeks. There will also be a short survey that appears on your screen at the end of this webinar. Your feedback is very important to us, and we want to provide you with as much value as possible through these webinars. If you would take just a few minutes to fill that out, we would greatly appreciate it. For those of you who might not be familiar with Richie May, we were founded almost 40 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish all of their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And with that, I'd like to turn it over to our 2 presenters today, Seth Sprague and Jordan Vasquez. Guys, take it away.
Thanks, Felicia, and good afternoon or good morning, everybody. This is Seth Sprague, CMB here at Richie May. I'm Director of Mortgage Consulting, and we're very excited to do this presentation for you all today on sort of the capital rule changes and the impact of the mortgage ecosystem. For those that don't know me, I've been in the industry about 27 years, worked at a variety of companies, and been at Richie May now about 1.5 years, but very excited to be joined here with Jordan. And I'll have Jordan introduce himself, and then we'll get started with the presentation.
Yep. Hi, everybody. My name is Jordan. I am an audit lead specializing in the mortgage banking audit industry. I've been at Richie May for about 6.5 years now, and we're super excited to talk about these capital rule requirements.
Nothing more exciting on a Wednesday afternoon than capital rule changes. So today's agenda, we're going to cover sort of 3 major topics. And then we'll hopefully have a question and answer here at the end. But the first part we're going to cover is about the Basel III Endgame rules that came out. Then there'll be a non-bank capital rule refresher. We're almost a year to the date that we did a similar presentation about those non-bank capital rules. Jordan is going to then take over the presentation and do a demo of the non-bank capital rule calculations so that you're a little bit more grounded and feel a little bit better about it. And then I'll close it out and we'll have some question and answer. We should have time for question and answer here at the end. So again, excited to be here, excited to be talking about capital rules, and we'll start with sort of the Basel III Endgame. And we may have some people that are like, well, I'm not a bank, so this doesn't matter to me. We'll talk about why this matters for the entire mortgage ecosystem, as we like to refer to it. But on Thursday, July 27th of this year, jointly, Treasury, OCC, Federal Reserve, and the FDIC all issued what was called the new proposed bank capital rules. And effectively, this has been sort of dubbed Basel III Endgame rules. But these rules, as proposed, and they're only proposed rules at this point, would go into effect beginning in July of 2025. So, and then they would be followed by a 3-year sort of implementation window. Who's impacted by this? Well, it's all banks above 100 billion in total assets are going to be forced to comply with the new or more stringent capital rules as proposed. So Senate Bill 2155, which was passed in 2018, sort of allowed this differentiation between sort of the very large banks and sort of the other banks. That's going to go away as these rules have proposed. We'll talk about those implications here in a second. this is from the Federal Reserve, but it's expected that, all of the banks can comply with these rules, quote, easily, without changing their dividends through just sort of retained earnings. Full compliance would be required in 2028. We'll note here that the vote to approve these rules was not unanimous. In fact, the dissenting votes, as this was passed, very much brought up the concept of the fact that this is going to have an impact, a huge impact potentially to the mortgage industry. Further, the MBA actually was front running some thoughts around the Basel III Endgame rules and its impact to the mortgage industry. So while these are proposed rules, comment period is open until November 30th. Working with the MBA and other trade groups on the kind of their thoughts around and its implications around mortgage. But as presented, we're going to present the rules today and talk through some of the impacts sort of on the mortgage industry. But before we get started, we're going to have our first poll question of the day, just so we level set kind of who's in our audience today. So Felicia, if you could bring up the first poll question. And the full question is, what type of institution do you work at? A bank, independent mortgage company, or other? We probably have a kind of a wide dispersion of folks on the call, but we just try to want to get just a general feedback as to who was on the call. And Felicia, when we start to get to critical mass, let me know, and hopefully we can publish those results.
Yes, it looks like, I'm sorry, hold on, there we go. It looks like most everybody is at an independent mortgage bank.
Okay, good. Thank you. So again, we're going to talk about bank rules for a second, and for the non-banks in there, make sure you hang in there because it is going to be interesting conversation to where this goes. So these are a bunch of stock tickers, and I think I ripped this from Compass Point on July 28th after the capital rules came out. And again, these are the banks that are impacted, particularly the category 3, or in particular the category 3 and the category 4 banks. And you may recognize some of these tickers, you may not recognize some of these tickers, but Fifth Third Bank, Truist Bank, PNC Bank, US Bank, M&T Bank, Key Bank, Regions Financial Bank, New York Community Bank, which is now part of Flagstar, right? That's the aggregate of those. Those are all banks that are in these category 3 and category 4 banks that previous to these proposed rules had, I will say, more lenient capital standards. One of the big areas that they had more leniency, easy for me to say, is around the amount of MSRs that they could hold to Tier 1 common equity. So category 1 and category 2 banks here were already limited to 10% of Tier 1 common equity in MSRs. The category 3 and category 4 banks can hold up to 25%. As the current rules are proposed, those rules for category 3 and category 4 banks are going to change. Now they can hold less mortgage servicing rights to Tier 1 common equity. Okay, that's going to have some implications as it trickles across the mortgage industry. One of the other areas that's changing for all banks on this is that the amount of capital that they're needing to hold is going up. And capital comes with costs to the consumers, right? At the end of the day, if a bank has to hold more capital, that means they're going to either lend less and or require more return on capital. So again, all banks on this list are impacted, but the most impacted banks from a mortgage perspective are the category 3 and category 4 banks. So many of our IMB friends out there may have warehouse lines with these banks. They may have MSR financing facilities. They may have Ginnie Mae or EBO facilities, right? It's important to understand that these banks are becoming under more capital requirements. More capital means higher costs, ultimately, that they need to pass on. So again, just as we talk about the banks impacted, let's do a little bit of a deep dive here on the loans. One of the major changes that's being proposed under these rules is that the amount of, for banks, again for banks, the amount of regulatory capital that they're going to have to hold for loans is now going to vary based on the LTV of the loan to value. Higher loan to value loans as proposed would get a higher risk weighting. A higher risk weighting translates into more capital. Okay. Currently, most mortgage loans sort of receive a flat rate when it comes to the amount of capital that they need to go. You can see on this schedule, which is from the Wells Fargo trading desk and their bank blast around these capital rules, is all of a sudden those higher LTV loans are going to require more capital. Okay. Again, I'm an IMB. Why do I care? Well, you might be selling jumbo loans to some of these banks. You might be originating doctor loans. You might be originating non-QM mortgages that may be higher in LTV, loan to value. They are going to, in essence, require a higher yield if these rules are unchanged to hold those loans on their balance sheet. Why? Because they now have to dedicate more capital. That dedication of more capital to those loans is going to cause probably the pricing to deteriorate on these loans. So if you go back and listen to the early calls of Q3 earnings from a number of publicly traded non-depositories, IMBs, they talked about this as an opportunity. Well, we might be able to expand our jumbo originations because we think banks are going to back out of this space due to these new capital rules. And I'm like, well, yes, I could see banks backing out of the origination space, but remember, IMBs typically don't hold loans on their balance sheet in the form of a whole loan, so they're going to need somebody to buy these loans. And if it's not the banks, it's going to have to be somebody else. So again, you'll be interested to see how this goes through. Having gone through some conversations with some of the Washington, D.C. trade groups, this is an area that's actually gotten a lot of focus from D.C. And I would expect that there may be openness from the various regulatory authorities to revisit these loan to value risk weighted assets. Okay, so this seems to be one that they've gotten the attention of, and they realize that this might be creating some illiquidity. This is going to drive costs higher to consumers. And so there may be some willingness to revisit this risk weighting LTV concept. But as presented, this is going to pose a potential problem for banks. Let's talk about the MSRs for a second, right? Again, as we talked about, no change to those category 1 and 2 banks. They were already under a 10% cap, okay? The new rules affect those category 3 and category 4 banks. And again, that would require that if they go above 10% of tier 1 common equity in MSRs, that would require it being dollar for dollar capital. That's very expensive capital, right? You have to put a dollar capital in for the asset. The problem, as experienced by any of these hard caps, either a 10 or 25%, is that the bank will manage to a number less than that. So while none of those category 3 or very few of those category 3 and 4 banks, I shouldn't say none, there are a couple, are in that 10 to 20%, 25% level, all those banks won't be at 10%. They're going to pare that back to something more like 7 or 10%. So you may see entities having to sell servicing. We already are seeing a lot of these banks, and I'm going to flip back a couple of slides, assuming I can find my mouse, to go back and actually look at their concentration of MSR asset. And what we're already seeing banks do today is sort of strip MSR trades. And so at the end of the day, these banks that are in here are already stripping servicing on terms of certificated Fannie and Freddie transactions. They're reducing their balance sheet. They are de-levering. Okay, that's having an impact on their willingness to buy MSRs potentially. Okay, if they have a correspondent channel, they may be revisiting the correspondent channel because the correspondent channel is nothing more than a mechanism to bring in servicing. So again, if you're participating with these banks in the correspondent channel, have those open communications. What's your capital plan? Do you plan to stay in these channels long term? What's your appetite as you go through there? I've heard several folks talk about the 250% risk weighting asset that the MSRs are. And coincidentally, that's in the same risk weighting that the non-bank capital rules are for Ginnie Mae risk-based capital purposes. Okay, what does that 250% risk weighting mean? That means that based on the capital level that these banks need to hold, they have to hold 2.5% or 250% times the capital. If the capital for these banks is currently 8% and it increases to 9% under these proposed rules, they actually, the MSR asset, while its risk weighting isn't changing, they have to hold more capital because they have to multiply the 250% times a larger denominator. Oh no, not so good with numbers. 9% versus 8%. So it's requiring capital to go up. So even though the risk weighting isn't changing, they are going to be required to hold more capital. That may reduce their willingness to hold servicing. The initial reactions out there, and again, there's always this immediate reaction when any of these capital rules change, but immediately the category 3 and category 4 banks were looking at these capital rules going, okay, how do we want to consider deploying capital in the future, right? Non-banks viewed this as a potential windfall, as banks might exit that sort of their mortgage footprint. They might be less competitive in the correspondent channel. They might actually sell servicing. All those create opportunities for people to come in and do something in this space, right? Buy more servicing, buy more correspondent loans, whatever. The trade groups are very concerned about the mortgage ecosystem. Not only the MSR side, but also warehouse lending, MSR advance and financing, and even the correspondent channel. And one of the side notes that some of the equity analysts were pointing out was many of these banks that were in category 3 and category 4 sort of were like kind of happy with their size, didn't necessarily want to merge. They're getting no capital relief anymore from staying in that smaller level. So the expectation is once DC becomes a little bit more friendly in terms of bank mergers, which could happen with a presidential change, which can happen with a change in the Senate, they expect those category 3 and 4 banks actually start to merge, which will lead to less banks in the space. And as those banks merge, they're going to have to manage both their MSRs and their warehouse facilities. This is from New York Community Bank's Q2 earnings presentation, where they're using, this is from Inside Mortgage Finance, but they're listing the largest warehouse lenders' commitments. And you can see that category 1 bank, JP Morgan Chase, category 3 bank, Truist, category 4 bank, M&T, Flagstar, New York Community Bank. Okay, so 3 of the top 10 banks that are warehouse lenders are in category 3 and 4, and one of them's in category 1. By no means am I implying that any of these banks are exiting the warehouse lending space. That is not the intent of this slide, and I'll be crystal clear about this. I have no indication that any of these banks that I've just mentioned are exiting warehouse lending. But I could tell you what they're more likely doing is evaluating whether the cost of capital on a warehouse line makes sense under these new capital rules. And it'll be interesting to see over the next couple of years, certainly once these rules get finalized, as to how they want to move going forward. There may be absolutely no change by any of these banks in terms of their willingness to lend in the warehouse space. or there could be a change, right? So it's important for our clients to understand who are your warehouse lenders, which you obviously know, what category are they in, and do you have a representative diversified risk where you've got enough banks that are not in category 1, 2, 3, or 4 so that you have a consistent set of warehouse lines. And I realize, in full disclosure today, most people are now rolling their eyes going, geez, so let's talk about warehouse lines. If you only knew, I've got 4 warehouse lines and they're at 20% utilization, but I got it, right? Origination volumes are low. But one of the things we always want to advise people on is, well, let's think about a refinance activity, right? Let's think about volumes going up, right? Do you have enough warehouse coverage then? I realize you probably have plenty of coverage today, but thinking about the MBA forecast, thinking about the fact that people believe rates are going to be falling at some point in the future, think about, don't be trapped into it. I got plenty today, don't worry about it, okay? And remember, as those warehouse lines expand and they actually are committing to it, their capital costs are going up. So they may not let you expand those warehouse lines as much as you used to. Co-American, Fifth Third, and there's a couple others, banks not mentioned here, they've already exited the warehouse space, right? So it's something to continue to monitor due to these new proposed capital rules. And in summary, before we kind of pivot to the other topic about their non-bank servicers and those capital rules, just remember that a couple things. One, they're proposed rules. They're not finalized. Comment period ends November 30th. There's a couple of things that can happen. I'm not saying any of these are going to happen, but they could happen. One, they could get so many comments in that these never get to final rule. That's a possibility. There have been previous capital rules that have been proposed that have never actually gone into effect, okay? If left unchanged, these higher capital rules will force all those affected banks to review their concentration, their higher risk-weighted assets, MSRs, 250% risk-weighted asset, warehouse, 100% risk-weighted asset. Those are higher risk-weighted assets. They need to really figure out how much they want to be in that space. For non-banks, and also for banks that aren't impacted, that aren't above 100 billion of assets or larger, they may be getting so much business in if some of those banks leave that they may not be able to handle it, okay? So just remember, oh, I don't have any banks that are impacted. Well, remember, your banks are now going to potentially get more volume in on both MSRs or warehouse lines, and they may have to sort of pick and choose who they want to have for customers. For non-banks, very important to manage those relationships. It's very important to monitor the MSR market. It's very important to monitor, are you getting reduced liquidity within that correspondent channel? Are your costs in your warehouse lines going up? Are you going for MSR financing and advanced lines and people aren't willing to give it to you? Those are all cash items that those IMBs, non-depositories, need to understand. The bottom line summary, and I feel like I'm running for Senate here, is that, you know, cost to consumers will go up for mortgages if these rules are left unchanged. And liquidity could dry up in certain segments for certain loan types, depending on what happens with those final rules. That's the bank side. It affects the IMBs. You're an indirect counterparty, or you're a direct counterparty to those banks. But those new capital rules, while not directly impacting you, certainly can impact your counterparties, certainly can impact your liquidity, certainly can impact a number of factors for you, okay? May get some questions on this at the end, but we're gonna go to our next poll question. And so the poll question that we've got here, after hearing my diatribe here, is how much impact do you expect the Basel III endgame to have on the mortgage ecosystem if left unchanged? And the answers are material but manageable, material but worrisome, not material, unsure, taking a wait and see approach, but going to pay close attention. So when we get the, Felicia, I'm going to pause here. I know you've got the poll question up, and when we get those responses in and you publish them, if you can let us know what the top answer was before we pivot to the non-bank servicer capital rules refresher. And Jordan walking people through a calculation. And I'm
We
going
sure
to take
will,
a sip of
Beth.
soda.
And again, we would like everyone who would like CPE credits. So we have a lower number so far than voted for the first question. So I want to give it just a few more minutes to make sure that everyone who's looking for CPE credit can actually get it. Because we hate to...
And some people may need to wake up, because I know bank capital rules are a terribly exciting topic.
That did it. It looked like everyone's in now. So the results are pretty interesting. Unsure and manageable. The first and fourth answers seem to be almost equal.
Gotcha. Well, look, we've managed through other capital changes in the past. I would tell you that I think it's manageable to a degree, but I do think it's something to pay close attention to going forward. So stay tuned, stay involved with the NBA, and if you're with what's going on. Okay, we're going to pivot, and I'm going to kind of run through the next set of slides a little bit faster, because that was all new information. This should be a refresher for you. The good news is it's September 27th, and some of these rules go into effect in 3 days. So when you get to the Jordan part of the presentation, you really want to pay attention. Make sure you got these calculations down, because in 3 days you're going to have to do them, and hopefully you've already done them as of June 30th. These rules came out last August, believe it or not, August 17th, 2022. And this was a joint statement by the FHFA, which is obviously the conservator of Fannie and Freddie, and Ginnie Mae. And understanding what's changing is very important to you. And we did a presentation about a year ago on this to highlight this. And we thought it was time to bring it back with a little bit new information and to kind of talk through, again, that calculation that Jordan's going to share with you. It's critically important for our Richie Mae clients, and actually for the industry, to understand all these implications. So at the highest of level, sounds like a quiz question. Effective 9/30, effective 4 days from now, I don't know, 4 days from now, 9/30. Actually, you do this as a 9/29, right? The new calculations for the tangible net worth, base liquidity, and liquidity buffer come into play. On 12/31 of this year, if you originate more than $1 billion of loans across a rolling 12-month period, you're going to have an additional origination liquidity charge. There's some third-party ratings that you need to do for Fannie and Freddie. The good news is that the risk-based capital rules for Ginnie Mae were delayed a full year. And then we've got some other rules that come into effect for some larger entities as of March 31st, 2024, which sounds like a long way from now, but it really isn't, okay? So as we think about this at a high level, remember that minimum net worth calculation, FHFA, is 2.5 million plus 25 basis points times the outstanding UPB of 1 to 4 family loans. And for Ginnie Mae servicing, it's 2.5 million. It's 35 basis points for the Ginnie Mae servicing. So as we talked about, I think last time we talked about the capital rules, we're really starting to differentiate between FHA servicing and Ginnie Mae servicing in terms of that minimum net worth calculation, right? The minimum capital ratio is still tangible net worth to total assets has to be greater than or equal to 6%. Base liquidity, again, 3.5 basis points of all agency servicing, 10 basis points for the Ginnie Mae servicing. And then the NPL charge for incremental delinquencies is in place as well for those non-performing loans. The allowable assets that are for the calculations, while we vastly align what FHFA and Ginnie want with a couple major differences, which we'll talk about. There's a couple differences in between what's allowable assets, and Jordan will spend, when he goes through the calculation, a little bit more time talking through each one of these. There is slight differences here. Remember, cash is always a good asset and cash equivalents. As you think about the tangible net worth calculation, there is a slight difference in here Goodwill and other intangible assets, they get kicked. Affiliated receivables, they get kicked. Deferred tax assets, net of deferred tax liability, they get kicked, right? For the Ginnie Mae side, they have that language in there around the valuation adjustment of certain assets, okay? That allows Ginnie Mae to peer through your financial statements a little bit and go, I don't like that one. Kick that one out, okay? So it's very important you talk to your agencies, very important you talk to your audit firms, make sure that you've got these calculations down. But remember, you got to be greater than 6%, okay? In full disclosure, don't hear a lot of angst around this one, though depending on your structure, you may be have trouble in this, but a typical mortgage company that doesn't have a lot of MSRs is probably going to be okay in this calculation. The minimum net worth, and remember, this is the minimum net worth. They can always require more, right? We're differentiating again between the Fannie and Freddie servicing, but there's very strong alignment here on the minimum net worth calculation. When it comes to the base liquidity, again, this is effective 9/30. The origination liquidity has the 12/31 effective date. We're starting to differentiate on the servicing side, right? What is the remittance structure? Remember, schedule, you have to make advances on principal and interest for delinquents. Actuals, you don't. So now we're risk weighting that Fannie and Freddie servicing differently. Never been done before, right? Ginnie Mae servicing, 10 basis points times the outstanding UPB, and PLS, other servicing, 3.5 basis points, okay? There's an incremental origination liquidity that's coming into play as of 12/31. And I'm very excited for Jordan to talk us through this one again, because this is new. If you originate over the prior 4 quarters, 1 billion of servicing. So remember, that's the prior 4 quarters. So that's a calculation that sometimes you might be over $1 billion, sometimes you're not. Make sure, in my opinion, that you're calculating this every time you do the calculation, because what you don't want to do is start to have a good production function of, oh, we got over $1 billion, and forget that you have this origination liquidity requirement. So it's 50 basis points times the loan held for sale, pipeline loans with interest rate lock commitments after fallout, okay? My advice is to do this calculation regardless of what your volume is. And as volumes tick up and we start to get in a refinance cycle, I want people that are at 750 million in production to go, I'm now going to have that origination liquidity requirement. Don't get trapped that you flipped over $1 billion over the prior 4 quarters and you don't have the adequate origination liquidity to cover it. Very, very important. We'll all be happy when the refinance wave occurs. Well, servicers won't be, but the origination side of the business will be. But don't forget you have this new requirement starting on 12/31 of this year. Real quick, eligible assets for that liquidity, largely vastly aligned here. On the Fannie and Freddie side, you do get 50% of that unused portion of committed agency servicing advance lines. Ginnie Mae is giving you credit for P&I, T9 foreclosure advances, right? They're giving you that credit because that is money that you should be getting back in at some point, so they don't want to double ding you that you've had these advances and you're not going to get it back. The risk-based capital rule. Okay, this is the one that's caused a lot of consternation, right? This is the one that got a lot of chatter. Ginnie Mae did delay this to 12/31/2024. It was actually going to go into effect initially at the end of this year. Due to market conditions, they did delay this, right? But remember, your adjusted net worth less excess MSRs, and excess MSRs are defined as MSRs that exceed that adjusted net worth calculation, right? This ratio has got to be above 6%. So again, if you have a lot of MSRs and not a lot of equity, you could be running afoul of this calculation. Hopefully you have started figuring out your glide path out of that problem if you're there, but this is going to be a significant problem for entities that are hoping that this goes away. I have no indication that Ginnie Mae is going to delay this further, but it's always up to Ginnie Mae to decide what they want to do. This is the calculation that got so much grief that they delayed it. We're now, let's just say, 5 quarters from having to implement this. So if you have not done this calculation, it's certainly time to start thinking about it. And just as a quick refresher here, risk-weighted assets, remember, the higher the risk-weighted asset, i.e. MSRs, the riskier the asset is deemed. So cash, 0 risk weighting. And again, Jordan's going to walk us through a great example of this in a few minutes. But remember that 0 risk weighting is actually a good thing for the capital calculation. The bigger the number, actually it's retracting more capital to it. Okay, and that's for people that don't live in a capital world. That is always one of those areas that gets people a little bit confused. Large depositories. So this is large non-depositories. If you have over 50 billion of servicing, right, of single family servicing, there's a liquidity buffer you're going to have to do actually as of 9/30, right? You have to have capital and liquidity plans in place as of March 31st. Your servicer must be rated, right? If you've got above 50 billion of servicing, you must have 1 primary servicer or a master servicer rating. Above 100 billion, you've got different requirements above 150 billion. Remember, this is one of those areas that may not impact you, but it may impact some of your counterparties that may be aggregators. So again, while some of these capital rules, you're like, God, he's talked now for 40 minutes on capital rules. Let's get to the Jordan, let's get to the good stuff. Let's get to the Jordan calculation. We will, but just remember, just because you aren't impacted, it doesn't mean your counterparties that aren't impacted. It just makes sure you understand that as we kind of flow through time here. We're going to take one more poll question here, and then we're going to have Jordan. It's going to be the Jordan show, and I'm going to come back at the end here. So Felicia, we got one more poll question here. Poll question is, what is the, see, I told you there's going to be a quiz question. What is the effective date for the tangible net worth eligibility net worth base liquidity requirement for Ginnie Mae servicers? Is it 9/30/2023, 12/31/23, someday, or never? And for those that answer never, maybe they're on the wrong call.
And again, we want to make sure that everyone who answered the first 2 questions has an opportunity to answer this 3rd question in order to get CPE credit. And just to highlight, the 4th question that we need answered will be after the demonstration. And we're getting close. There's still a few individuals out there. Want to make sure
Fingers crossed they get the answer right. Otherwise, Jordan's not going to come on and do the calculations.
Just a few more, folks. I'll wait just a few more seconds. Okay, well, here we go.
They do okay?
They did okay.
Hopefully they got the answer right, which is A, right?
So 85% said 3 days from now, September 30th, and 15% said the end of the year.
All right, well, 85 is a passing grade. That's a solid B. We might round up to a B+. I think you've done well enough that now Jordan will come on and entertain you with the calculations.
Sounds good. All right, everybody. Okay, so here is our calculation. So in this portion of the webinar, I wanted to kind of split these requirements into bite-sized pieces. So basically bucket them out, just similarly to the way that Seth was explaining them. So here is our fancy spreadsheet, as a good accountant would do, create a fancy spreadsheet so that this calculates everything for us, kind of. All right, so we've got our first bucket, which is our net worth requirements. Our net worth requirements, the values that we're going to need on the net worth requirements, just as Seth explained, is going to be our servicing portfolios. So the first thing we're going to need is everything from the MSR valuations is normally where we pull them from. If you have your internal servicing portfolio, we need to bucket them between Ginnie, Fannie, Freddie, and then other servicing UPB. So we'll want to get the total of the total servicing UPB. And then we're going to take our net worth or total net equity. And this will be per the financial statements. So if you run just the financial statement reporting, whatever your total net equity is, that's what we're going to do. We're going to take our total net equity. We're going to deduct all of our unacceptable assets. So Ginnie Mae, again, has unacceptable assets that are similarly aligned to Fannie and Freddie. Some are going to be Ginnie Mae only, which I have outlined here in our calculation. So what we're going to do is take any goodwill, and all of these numbers are fictional, so I just plopped a number in here. So we're going to deduct those from our initial net worth or total equity to get our adjusted net worth. With our adjusted net worth, we're going to compare that to our minimum net worth, and obviously it's over. With the new capital requirement, you're going to have to multiply each of those servicing portfolios by the 35 bips or the 25 bips, depending on what the entity is. So for this one specifically, we're taking our Ginnie Mae portfolio, multiplying it by the 35 bips as per the requirement. And then with this one, we're going to take all of our non-Ginnie Mae portfolio and multiply them by the 25 bips requirement. Initially, when we do that, we're going to go ahead and add them all up to end our minimum net worth as per the MBS guide to get what our total minimum base net worth on the Ginnie Mae, Fannie Mae, and Freddie portfolios. And essentially what we want to see is that the total net worth or adjusted net worth, taking out all of those unacceptable assets, is greater than our minimum net worth. So here we can see that for our Ginnie Mae, it is met, and then for our FHFA, it is also met. So if at any time this flips is not met, then that means that you are not meeting the requirement. Essentially, that would be something that you would have to discuss internally. So high level, that's going to be our Fannie Mae, Freddie Mac, Ginnie Mae net worth requirements. Let's talk about the liquidity. So the values that you're going to want to pull for the liquidity are going to be that loans held for sale UPB, the IRLC UPB, net of pull-through. You're going to want to get the pull-through adjusted one. This should come from your trial balance, whatever the UPB is on the trial balance, and this should be from that hedge report. Then we're going to calculate the eligible liquid assets. So Seth kind of talked about this on the eligible liquid assets. I can kind of explain what that is. So again, most of them are aligned. So the unrestricted cash and cash equivalents for both the FHFA and Ginnie Mae. We have the unpledged available for sale or held for trading securities for both the FHFA and Ginnie Mae. So here we have the FHFA specific, so we can take 50% of the agency servicing advanced lines of credit. And then for Ginnie Mae, we're able to take that P&I, T&I, and foreclosure advances and add that to our eligible liquid assets. So this would be your total liquid assets based off of the categories that are listed here. We have it more detailed inside the slide deck if you want to dive into that a little bit more. So once we have our eligible liquid assets here, essentially we're going to get into what the calculation is. So the actual liquid calculation is going to be the greater of the 1 million minimum liquid asset or this calculated minimum liquid asset here. So what you're going to do is going to multiply your portfolio balances based off of how your reporting is. So if you do actual to actual, which is normally our Fannie Mae portfolio, is normally actual to actual. So for the Fannie Mae, Freddie Mac, you're going to multiply that by, or if you do actual to actual in both, or schedule to schedule, schedule to actual, depending on how you guys are reporting, you'll multiply that by the 35 bips if it's actual to actual. And then for schedule to actual, you'll multiply that by the 7 bips. So this is where Seth was saying that they're a little bit different in that calculation. And then if you have any additional reporting or investors say you're not doing the traditional actual to actual, you're doing schedule to schedule, then you'll multiply by the 7 bips instead of the 35 here. Again, that's just going to be depending on how your reporting is to each of the regulatory bodies. And then our Ginnie Mae calculation is going to be that 10 bips of the Ginnie Mae UPB. So what we're doing is taking our total Ginnie Mae servicing portfolio, multiplying that by the 10 bips here. And then any other servicing outside of that, we would just take the 35 bips on any other servicing that we have outside of that. So in this example, we don't have any of that. Essentially what we're going to do is add all of those values up, and essentially this is going to be our minimum liquid asset. So again, this is going to be the greater of 1 million or our minimum calculated minimum liquid asset, which in this case is 5.4 million. Our eligible liquid assets need to be greater than this number. So I have a fancy formula going here saying that yes, our eligible liquid assets are greater than the 5.4 million. And these two changes here, I have the effective dates here. Again, this is going to be the 9/30 calculation. This is also going to be a 9/30 calculation. The additional piece to our liquidity is going to be that originated piece. So as Seth mentioned, that if you are originating more than 1 billion UPB in a rolling 4 quarters, you would have to tack on this calculation to your minimum liquid asset balance. So essentially over here, I've got an example of kind of our rolling 4 quarters. So here I have it all split out by Q2 of the prior year, Q3, Q4, and so on. So here you can see kind of how those calculations would work. So in our first rolling quarter for Q1, we didn't meet that 1 billion. In our second quarter, we didn't meet it. In our third quarter, we didn't meet it. However, in the fourth quarter, just depending on how the production is going that year, you could meet this at any point in time, just depending on the ebb and flows in production. So kind of our recommendation is that you're calculating this quarterly so that way you understand that if you do hit that 1 billion mark, you will have to tack on that additional calculation for the liquidity piece. So when you're looking at it, just make sure to keep an eye on it. Make sure that you're doing the rolling 4 quarters, and at any time if this flips that there's a billion, then you're going to have to add that to your base minimum liquid asset requirement. So essentially what that means is for that calculation, you're going to take 50 bips and you're going to multiply it across your loans held for sale. So again, this is why we collected that UPB up here for loans held for sale, coming from the trial balance is where I would pull this. And then you're also going to calculate 50 bips of your IRLC net of pull through. So you'll take your production report, or sorry, your hedge report. You'll look at your UPB of IRLC's net of pull through, multiply that by the 50 bips, and then you're just going to add those to your new minimum liquid asset balance. So your total minimum liquid assets in this case, our total is going to be 9,150,000, and our eligible liquid assets needs to be higher than this 9,150,000. Again, any smaller sellers originating less than $1 billion of the mortgages of the last 4 quarters are excluded from this. So, but if you had ever hit 1 billion or you project that you're going to hit 1 billion at any point in time, I would probably calculate this out to make sure you're not doing that across the year or at the end of the year. And again, this is 12/31/2023. So this is in effect for this year end. All right, and then we have our institutional-wide capital requirements. This is going to include that risk-based capital ratio from Ginnie Mae. So just to start out, the number that you're going to need is going to be our total assets per the financial statements. We have this new category called excess MSR. I know excess MSR has been kind of thrown around in different kind of terminologies throughout the industry. Essentially, the way that we want to define excess MSR in this calculation is going to be the MSR value on the face of the financial statements minus the net worth. So anything excess, so let's say your MSR value is 300,000, or sorry, 300 million in this instance, and your net worth is 250, the excess is going to be the 50 million of that value to your total net worth. So we're going to calculate our leverage ratio, which is just going to be our adjusted net worth over our total assets, and that should be greater than 6%. And then once we know that that's met, effective 12/31/2024, it's going to be a little bit different for the Ginnie Mae side. So let's talk about that a little bit. I know Seth kind of showed the table. Let's kind of go through how that is calculated. So essentially, for this percentage, the kind of calculation here is going to be that risk-based capital ratio. Is going to be the adjusted net worth minus those excess MSRs value divided by the rated or risk-weighted assets. So if we go back to our inputs here, let's look at our weighted risk assets. So we're going to look at the financial statements and we're going to pull all the numbers. Essentially, you don't really need to pull these. I mean, you do need to pull these in order for it to calculate what your total weight risk is, since this will be any other assets that are not included in these categories. But essentially, you're going to want to list out your cash and cash equivalents. If you do reverse mortgages, that's where you put there. Prepaids, anything deducted from the adjustable net worth. So that's going to be, in this case, our goodwill. Here, we're going to have our loans held for sale balance, any other loans that don't kind of fit into those government and conforming loans held for sale categories will get a little bit of higher risk weight. And then we're going to have our gross MSR value. So one thing to note here is that if your gross MSR value is, again, over that adjusted net worth, you're going to want to just use the adjusted net worth number. So looking at here in this example, our MSR value is 300 million. So 300 million is greater than our total equity number of 250 million. So we're just going to use the 250 million. And then this is just going to deduct all of this out of the total adjusted weighted, or sorry, the total assets. And then basically this is just the sum of the risk-weighted asset values here. All right, so now that we know what our total risk-weighted assets are based off of the Ginnie Mae table, we can come back over here, and essentially what we're going to do is take our adjusted net worth, which is that 249,500 here, after we deduct all of the unacceptable assets. We're going to subtract our excess MSR value here, and then we're going to divide it by our total risk-weighted assets that we calculated on that inputs tab, showing the actual risk-weighted. Now, kind of the key here that we want to keep in mind too, so this has to be above 6% is a requirement. The way that this could get a little bit finicky, I know some balance sheets or some clients have a really good hefty portfolio. If that value ever gets too high, again, you could blow this if you have your MSRs way too high in value. Now, with that said, this is just something that you should keep in mind for that 12/31/2024 calculation. If you're not calculating this as of yet, I would highly encourage you to try this and make sure that you're understanding what the calculation is saying and also understanding what the implications of this as far as that capital requirement. But yeah, so this is going to be the basic calculation. And I will kick it back over to Seth.
All right, we're in the danger zone now because I'm going to try to take the screen back. So, you know, that's always a problem. But Jordan, wonderful job. Look at this, I can't even turn my camera back on. That's how technically savvy I am. Great job, Jordan, with those calculations and cleaning up all that I said. If you need help, please reach out to Jordan or the team here at Richie Mae with those calculations. That's a wonderful spreadsheet on it. You know, what to do next? We got to get to our final poll question so you get people CPE credits. Really, the thing is, understand these rules, reach out if you need help. And most importantly, as we talked about, understand that there's just broader mortgage ecosystem impacts across all of these rules. Regardless of whether or not you're under $1 billion or you don't have servicing, this is going to impact the entire mortgage ecosystem. So it's really important to understand how this is kind of trickle through the entire piece. We do have some additional resources for you here. You will get this deck. In fact, Bob Brookschmidt and the MBA were just in DC talking about the endgame rules. But I do want to get to the final poll question. And while we're doing the final poll question, I'm going to answer one of the questions that we've gotten in. And we may not have time for all the questions, so I do apologize. But poll question to get your CPE credits. How comfortable are you with these new calculations now that you've seen through this presentation? Not good, a bit of comfortable. I am comfortable, very comfortable, gone down. While y'all are answering that poll question, remember you got to answer all 4 to get your CPE credits. Felicia, I think we got time just to answer one of the questions, and one of the questions that came in was about interim servicing. And interim servicing is an interesting topic, right? So interim servicing, it's who owns that MSR asset at the reporting period. So said another way, if you have entered into a bulk sale transaction and its close date is June 30th, yet you haven't sort of taken over that servicing yet, you own the MSR asset at that point in time, and therefore I would believe your UPB should count and your MSR value would count towards these calculations. So why I bring that up, and it's a great question on the interim side, is that if you're running afoul of one of these calculations and you try to get that sale done, like you need to understand that your counterparty might trip over them in that interim servicing period as well. So it's who owns the MSR asset has to count it. Whether or not it's been transferred to your platform is sort of irrelevant at that point. It's because they're going after the MSR risk, I believe, on the interim side. So interim servicing, it's who owns it at that point in time that Jordan's doing those calculations would be our answer.
And again, just want to make sure everyone who would like credit, we're just a few people short, that you do get your vote in before I close this.
Yep.
And it looks like we got everybody, so let me share the results.
All right.
2% is not comfortable yet. 36 are a bit comfortable. 51% I am comfortable, and 11% very comfortable on my way.
Excellent. Well, for those that are answering A and B, please reach out. We are here to help. We are your partners here in trying to help you through one, these calculations, and two, sadly, we've gotten a couple questions that we'll just have to follow up with folks. We do capture all of the questions, and we will reach out to you. Jordan or I will reach out to you with answers to all your questions. But we appreciate everyone's time today. Jordan, awesome job as always with that calculator. I'm sure you're gonna get a lot of emails from people that are gonna want to use that. I particularly like the fact that everything that you showed passed. So very positive in the mortgage space. So great job, Jordan, with that calculator. And Felicia, as always, thank you for all your help. We appreciate our partnership with all our clients. We're here to help. Please reach out to us at Richie May if we could be of any assistance, and we will follow up with specific answers to your questions that we didn't get to. We apologize, but as usual, we ran out of time because I talked too much. Anyway, thank you all. Have a great rest of your day, and hopefully you feel a little bit more better about these new capital rules calculations. Remember, you got 3 days before you got to start doing these, so you get on it. Thanks, everybody.
Thank you, everyone. Have a great day.